really going to cut through some of the noise. We've got a stack of analyses here from Fund at Mental, all zeroing in on the economic signals that could shape the Federal Reserve's upcoming rate decisions.
That's right. And it's a really interesting mix. We're talking employment revisions, global money supply,
Mhm.
things that could definitely sway policy.
Exactly. So let's unpack this. It's quite a collection of data points, wouldn't you say?
It really is. And what's valuable here, I think, is how these different sources offer a more nuanced look. They highlight indicators that maybe don't always get the spotlight, but are crucial for understanding the pressures on the Fed right now.
Okay, so kicking things off, let's look at the source titled We're Ready. This focuses on that recent unemployment report. And it painted a pretty grim picture, didn't it? Even if the headlines seemed okay at first glance.
Mm-hmm. Grim is a good word. Most of the job gains were part-time. And you saw this growing number of people saying they're willing to work, but, well, they just can't find a job.
So under the surface, not great.
Not great at all.
Yeah.
And what's really striking is how the bond market reacted. I mean, just boom.
Right. Tell us about that.
The 2-year Treasury yield dropped straight down to 3.5%. That's basically the market screaming it expects a big cut, like 100 basis points from the current Fed rate.
Wow, 100 points priced in almost immediately.
Pretty much. That report pushed market expectations for a September cut to, 100% certainty and like a 91% chance it would be at least 25 basis points.
So much for higher for longer, then, at least according to the bond market.
It certainly challenges that narrative, yes. The jobs market seems to be sending a very clear signal for cuts.
Okay, but then moving on, our next source, increases in cuts, throws in a different element. Some potentially, maybe positive news for inflation
Is true?
from OPEC plus Philam.
Yeah, potentially. They announced an increase in oil production about 137,000 barrels per day.
Now, the big question is, will that actually happen?
That's the multi-million-dollar question, isn't it?
Yeah.
It's a big if. Realistically, maybe only a couple of members like the UAE and Saudi Arabia can actually deliver on that.
But if they do,
If they do, it could definitely push oil prices down. And for you, the listener, that's a good thing. It's a potential positive supply shock.
meaning less pressure on U.S. inflation.
Exactly. Specifically, the energy part of CPI and PCE, the Fed's preferred measure. So, yeah, it could give the Fed a little more, flexibility, a bit more room to maneuver on rates.
Okay, flexibility is
Yeah,
good.
yeah.
But then we get to the source called data errors, and this is where things get genuinely concerning, I think.
Mm-hmm. This one's a big deal.
We're not talking small adjustments here. The Bureau of Labor Statistics, the BLS, they published the biggest negative revision ever recorded for their employment benchmark.
Ever. Think about that. It really makes you wonder about the reliability of the very data the Fed leans on so heavily.
So what did the revision actually show?
Well, get this. The headline payroll growth, the average monthly gain from March 2024 to April 2025, was almost cut in half. It went from about 147,000 jobs per month down to just 71,000.
So in half, that's
Yeah.
that's massive.
It's huge. It paints a picture of a dramatically weaker labor market. And that puts, immense pressure on the Fed. The conversation shifts completely.
How so?
It's no longer really if they'll cut rates. It's almost certainly how much they'll cut. It's like you've been navigating with a map, and suddenly you find out the map was fundamentally wrong.
Right. Which brings us right up to the present moment. Our next source, another test. We've got the August PPI and CPI inflation data coming out very soon.
Yep, these are the last big pieces of direct data before the next FOMC meeting. The final test, so to speak.
And investment banks are really leaning into rate cuts now, aren't they? Forecasting cuts like every quarter for the next year.
They are piling in. And the market itself, if you look at Fed funds futures, seems completely convinced, 100% certain of a cut at this next meeting.
And the bond market seems okay with that. The 2-year yield holding steady.
Yeah, the bond market seems comfortable with that 2-year Treasury sitting around 3.5%.
But there's always a but, isn't there?
Uh-oh, what's the but? Gold. Gold keeps climbing. It's like this nagging voice saying, hold on, things aren't quite right here. Even while investors seem fixated on easy money and rising equity indices, there's a divergence.
Interesting. Okay, let's shift gears slightly. Government spending. The source, the problem keeps growing, highlights the August budget deficit.
Mm-hmm. And it wasn't pretty. $345 billion deficit for August. That was quite a bit higher than the $305 billion expected.
Even with tariff money coming in.
Even with the tariffs. So what this means is the Treasury has to issue more debt. A lot more.
And they're planning to issue short-term debt, right? To maybe benefit from lower rates once the Fed cuts.
That seems to be the plan. issue short-term bills, hoping to lower interest costs temporarily when rates fall. But, for you and the economy long term, that's just kicking the can down the road.
Because it doesn't fix the underlying spending issue.
Exactly.
Yeah.
Without actually cutting government spending, all this debt issuance combined with potential rate cuts, it fuels inflation eventually, which then pushes long-term interest rates up. We need to talk trillions in structural change, not just billions in short-term fixes. It's a serious fiscal imbalance.
A ticking time bomb, you called it.
Feels like it sometimes.
Okay, finally, let's look at it doesn't add up. Despite some data points maybe looking better than expected here and there, like maybe a PPI print, there are these deeper currents keeping inflation as a worry.
Absolutely. And a key piece of evidence here is global broad money supply. Just look at July, it went up 9.3%.
9.3% in 1 month, globally.
Globally, pushing the total to something like $140 trillion. It's a staggering amount of money.
And the implication is?
Well, the critical insight, especially when you factor in things like tariffs restricting goods, is that you have this classic setup. Too much money chasing a limited number of goods. That is, by definition, inflationary.
So if the Fed does cut rates next week?
It just adds more fuel to that fire. It puts more pressure on prices, unless, of course, we're actually tipping into a really significant economic slowdown. But the signs, gold climbing, debt and deficits widening, they signal these deeper economic strains aren't going away.
So pulling it all together, what does this complex picture mean for you, our listener? It's this intricate dance, isn't it? Conflicting data, policy pressures, market sentiment, all swirling around.
It really is. And it directly impacts things like borrowing costs, the value of savings, the prices you pay every day. It's not abstract economics, it's real-world stuff.
Which leads to the big question, I suppose.
It raises this really important question for all of us watching. Can the Fed actually navigate this? Can they steer through these incredibly conflicting signals? Weak jobs pushing for cuts, but stubborn inflation and huge deficits pushing the other way without making a major policy mistake.
A mistake that could have, well, pretty far-reaching consequences.
Exactly. Consequences that could ripple through the economy for years.
Definitely something for you to think about as we watch how all this plays out in the coming weeks and months.